Hi, I'm Grant Stevens.
And I'm Chris Bernier.
And we're the two investment guys. This week, Chris and I want to talk a little bit more about some of the market factors, but also some of the things that you might want to be thinking about in your portfolio. You know, when we look at returns around the globe, just a quick summary, we've got the Canadian market down about 4% this year. Somehow it feels worse than it is, maybe off the peak of March. But interestingly, the S&P 500 is up about 6% and Germany's up 8%. So the returns are more on the positive than the negative. But the news flow, Chris, is very negative and the sentiment is very negative in the markets. And some of the macro factors are unchanged. I mean, we continue to watch Spain, and the bond yields there are now quasi in red flag territory. Italy is approaching an orange flag territory. You know, the China growth story slowing down, and in fact, global growth slowing down. So those culprits are unchanged, and it's going to be difficult to break that cycle with any near-term stuff. But there is a little bit of a bright light, Chris, and that's the earnings so far.
Sure, when we look at corporate earnings, we're about maybe a little better than a third of the way through the S&P 500 reporting earnings. And we're seeing about a 68% beat ratio. In other words, companies, about 68% of them, are beating analyst estimates on their revenues and profitability. But we would say that revenue line, the top line revenue growth has been very muted. Profitability has been pretty good, but it's been on the back of a lot of cost cutting. Companies aren't willing to invest in their business, to hire a lot of people, and that's and also giving limited visibility about their earnings going forward. They're remaining quite cautious. So our view is that that's likely to continue to keep employment growth somewhat muted. And when we look at employment, Grant, it plays a huge role in the economy overall, everything from government revenues all the way to housing.
Right. Well, you know, Chris, that's why it's one of the things that we bring up in more of our macroeconomic points when we talk about these things. Is it's pretty obvious to most people that employment's a big driver of the overall economy. But when you think about it, it also drives consumer confidence. It drives the consumption levels in the economy. And remember, in the U.S., it's about 70% of their whole GDP is the consumption side of things. And, you know, employment drives government revenues, so obviously it's in their interest to have, high levels of employment. And also on the consumer side, consumer debt, it eases some of the challenges that face people there when they go through, difficult periods. So we just can't overstate how the employment numbers and the data that we watch are so important in this overall picture.
Yeah, absolutely. Now, another thing about employment is we need to keep in mind that it's still positive. So employment growth is still occurring. That's a positive factor that's going on. And underlying, we're seeing a slow but steady improvement in the housing sector, which is important. And, we're seeing the automotive sector, which is another huge contributor to the U.S. economy, still quite positive. So those factors are all pointing to continued slow growth, not towards recession.
Right. So, Chris, really, we don't see anything on the horizon that breaks this slow growth cycle anytime soon. We've talked about yield a lot. And we want to explain that really quickly, and that is, portfolio yield is really about cash flow. What we're talking about there is owning things in the portfolio that pay you on a regular basis, whether it's monthly or quarterly, as in dividend-paying stocks, or funds that have regular distributions for you, because we're in a period where there probably isn't going to be a lot of stock growth, and you need to get a return out of the portfolio, and it's probably going to come from the cash flow. Now, for people in retirement, they're spending that cash flow, Chris, but people who are saving for retirement, well, that's coming to you in the form of, let's call it a rent check every month. And, you build a little bit of a cash pool there. So that's why we keep talking about the importance of yield in your portfolio. We're really talking about cash flow and getting paid.
And if we look back over the last 50, 100 years, dividend-paying stocks have far and away outperformed non-dividend payers. If you want to learn a little bit more about the yield story, give Grant and I a call. We want to thank you again for your questions and comments. Please keep them coming. You can contact Grant and I at twoinvestmentguys.com.
Join us next time. Chris and I are going to keep talking a little bit about the markets and give you some ideas to think about. So until then, I'm Grant.
And I'm Chris.
And we're the Two Investment Guys.